How did an investor make 100 times his investment in Ferrari? He used this strategy from a book from the 90s. I'll show you the 5-point strategy from the book, apply it to Ferrari using only the information that was available at the time, and then I'll show you how the investor did it and the hardest lesson that he had to learn. In Joel Greenblatt's 1997 book, You Can Be a Stock Market Genius, he explains 5 things to keep an eye out for in a spin-off. But what's a spin-off? When the parent company splits a subsidiary, department, or division off into its own independent company. But why? Well, many different reasons, but it is usually for the benefit of the parent. So we've got to make sure not every spin-off will be great. Some of them might be a dud. So from Joel Greenblatt's book, there's 5 things to look for. He calls them institutions don't want it, and not because of the investment merits. 2, insiders want the spin-off. 3, a previous hidden investment opportunity is uncovered by the spin-off transaction. So it might be a cheap stock, a great business, a leveraged risk, reward situation. 4, paying attention to parents can pay off handsomely. And 5, oh yes, keep an eye on insiders. Did I already mention that? So I'll simplify these ones down. We've got 1, forced sellers. 2, insiders want it. 3, hidden gem. 4, watch the parent. And 5, number 2 is really important. Now, let's apply those to Ferrari. Fiat actually bought Chrysler back after the 2008 global financial crisis, after its bailout. And during that process, that made a merger between those companies, and that was called Fiat Chrysler Automobiles, or FCA for short. Now, that business restructuring is another interesting way to look for investment ideas, which is detailed in Joel Greenblatt's book as well. Now, inside that big business of Fiat Chrysler, there was also Ferrari, its own specific division. And in 2015, Fiat Chrysler announced the IPO to spin off Ferrari. So, number 1, forced sellers. So having a look around online, I was able to find Ferrari's original IPO prospectus, and looking through that, we can see that Ferrari's selling 17 million common shares, which equates to just under 10% of the actual Ferrari business. With $52 per share, total price that I was selling for is $893 million. That being about 9% of the business, they're actually valuing that business at about $10 billion. This actually makes it a very small business compared to Fiat Chrysler. It's less than 10%. That actually makes it a smaller business that other large investors, so those institutional investors, they aren't going to really want to hold on to this investment. With the prospectus being over 300 pages long and how it's structured, it actually puts it in the too hard basket for most individual investors to either read through it, understand it. It is a very legal written document. So for me, I didn't even bother reading through it the rest of the way. There's easier ways that we'll see soon. So for every 10 Fiat Chrysler shares someone owned, you got 1 Fiat Chrysler share. Everyone effectively was forced to hold on to a Ferrari share, and they'd have to wait until the had IPO'd to be able to sell that. Some individual investors see things like that as, I guess, the mental gymnastics of it is it appears to be free money. We can imagine there would be some people from holding Fiat Chrysler, they bought Fiat Chrysler for a specific reason. They don't want to worry about having this smaller business, Ferrari, having it in their own portfolio. So there might be a few people that want to trade that off or sell it as soon as they have that opportunity. So what might the stock price do once it's listed on the stock exchange? Have a think about that while we go through these next parts. So number 2, insiders want it. So when I looked through that prospectus, I couldn't actually find how much the management team was actually having skin in the game. And so I couldn't actually tell if insiders actually wanted it. But I looked around a bit further. I found this article from Reuters from back in 2015, and it runs through how much the CEO at the time, Sergio, has increased his voting stake in the car maker to nearly 1% after benefiting from a stock grant plan, just as the company readies to spin off luxury brand Ferrari. So that makes him one of the largest individual shareholders in Fiat Chrysler, the world's 7th biggest car maker, whose share price has soared 75% since the Ferrari spin-off was announced last October. So that gives us a bit of an understanding that, yep, Sergio being a large investor in Fiat Chrysler makes him one of the largest individual investors in Ferrari at the time that it's going to spin off, getting 1 share for every 10 of his FCA shares. On to the next one. Number 3, hidden gem. So Ferrari is a luxury car brand, and it's a really strong, globally known brand as well. And what that means is it's got a really strong competitive advantage against its competitors. Warren Buffett calls that a moat, effectively like a moat around a castle that protects it from enemies coming from outside. In my 5M framework, moat is number 2 on there as well. Having a really strong moat is a big green flag. That's what we want to look out for in great businesses like this one. Now, the things that we need to look out for are in a spin-off situation is the underlying business, so Ferrari, is it actually profitable? And how much debt is it getting loaded up with? So is it going to be able to pay those things off in a reasonable time? And what does that look like? So usually in a spin-off, the parent company will take some of the capital or the money out of the spin-off company during the split. That way, the parent company looks as good as it can at that time, allowing the spin-off company to fend for itself. 4, watch the parent. Fiat Chrysler itself was in the middle of its turnaround or restructuring, and Sergio, the CEO of both Fiat Chrysler and Ferrari at the time, was an exceptional manager. And looking at his prowess in terms of how he's done that restructuring process up to that point where we're about to look at the IPO has been really good. And so in terms of management is number 3, 5M framework, and that's a big green flag. Sergio knows what he's doing. He's been able to show that through action and results in terms of being able to turn around the US part of the Fiat Chrysler business. If you want to learn more about that 5M process that I use and how I use that to make sure I avoid losers and find winning stocks, or if you just want to become a more confident investor, you can check that out in the link down in the description. I'll show you how to do it for free. It's my gift to you guys. So thanks. Now, what would you actually do in terms of Ferrari? With the information we have at the moment, would you buy Fiat Chrysler shares and wait and then get the shares during that IPO process? Or are you going to wait until after Ferrari now trades on the stock exchange and then buy the stock? Let me know in the comments below what you think or what you would do, or are you looking out for more information? Are you looking through that prospectus? Let me know. All right, let's jump in and check it out. In the first 4 months after Ferrari had its IPO, the stock price actually decreased 42% from its high down to its low in February. Why did it fall? Well, this is also mentioned in Joel Greenblatt's book, and it highlights that it might actually be a better opportunity to buy in the spin-off after it's IPO'd. So why does this happen? Well, like we kind of mentioned, forced sellers, the people that didn't want it, that then means that there's more supply of the stock and more people flooding the market with shares that they don't really want. Now, let's say we didn't invest until after the IPO. So in that February 2016, that 2015 annual report came out. Let's check the 2015 annual report and see what we could have gleaned from it. So jumping into Ferrari's 2015 annual report, we want to have a look around for specifics in particular. So the things we were looking out for, we wanted to see how much share ownership that the management team had, or how much skin in the game that they had. And then we also wanted to have a look for how much debt and if the business was actually profitable. So have a look at the financial statements. So having a look through this front end, we want to go through share ownership, and we can see here Sergio is the CEO of the business, and he holds just a little under 1.5 million common shares. Quite a considerable amount. That's a really good sign. We also want to go back and we want to find the financial statements. Income statement, we can see what the net revenues or how much sales they had. So in 2013, 2.3, 2.7, 2.8. You can see that's growing. Net profit, so we can see the net profit's actually increasing as well. 2.46 million, 265 and 290. And then let's go and check out the balance sheet. This is where we're going to find how the debt and liabilities of the business are. Total deficit and equity, a bit hard to see. We've got debt in here, and we can see the debt has increased considerably and been loaded up. So what we want to have a look for here is we've gone from $500 million to $2.26 billion, being the key difference here. Now we knew this would happen in a spin-off, so we want to go and check out this. So 23 is a note to the financial statement. So we want to go specifically to that one and find how this is structured and how we think the business is going to be able to pay that back. So we'll take note, 23, go and have a look at it. We'll also have a look at the cash flow statement. So how much cash is this business or Ferrari generating, and is it going to be able to pay that debt back? Cash into the business at the start of the year, it started with these numbers in those years. It's then got its profit before taxes, charges come out of it, and then what's left at the end of the day. So we've got cash flows from operating activities, cash from investing activities, and then cash from financing. So we can also see here that we've got proceeds from bank borrowings, being that a little over $2 billion, where we haven't had much previously. And then net change in financial liabilities with Fiat Chrysler Group, 3.2 billion, and that's come out as well. And really, it looks like all they've done here is they've grabbed some money from the bank, loaded that debt back onto Ferrari, and Ferrari has paid their financial liabilities with Fiat Chrysler, so that they've shaken hands, they're done and dusted. They've still got this money here, proceeds from bank borrowings, that they need to go and sort out. Like I said, let's go and check out that point from financial note 23. So notes to the consolidated financial statements, 23, debt. So this breaks down where the debt is and when it matures, so when it needs to be paid by. So we've got borrowings from banks, what's due within 1 year. So in the first year, we've got $905 million that's due, and then due between 1 and 5 years looks like it's the remainder of that money. So now this section here goes through the facility. So talking about the 2.5 billion euro facility with a syndicate of 10 banks, which is what they call this facility. So the facility comprises a bridge loan of 500 million euro and a term loan of 1.5 billion euro, that being the term loan. And that's a revolving credit facility on top of that of 500 million euro. So the bridge loan has a 12-month maturity with an option for the company to extend once for a 6-month period. The bridge loan bears interest at a rate per annum equal to the aggregate, and more details around that. December 31st, 2015, the proceeds of the bridge loan and the term loan were fully drawn down for the purposes of repaying financial liabilities with FCA. That just means they've used up all the money from those loans, paid off Fiat Chrysler, and they need to pay it back. The bridge loan was fully drawn down by the company. The company intends to refinance the bridge loan prior to its maturity with longer term debt, including through capital markets or other financing transactions. Considering those things and how it's been structured and the fact that Sergio actually has some significant skin in the game, I've got some pretty good confidence that the business is going to be able to find various capital or loans to either restructure that debt and be able to pay it back in a reasonable time frame. Now that we know that 5 steps, strategy to go through, and we've applied it to Ferrari right at its IPO with the information we had at the time. Let's have a look how our actual investor did it. Our investor is Guy Spier. He's pictured here on the right with Warren Buffett in the middle and Mohnish Pabrai on the left. And this is a picture from 2007 when they both were the winners of a charity auction to have lunch with Warren Buffett. So Mohnish on our left is also an exceptional investor, and he actually found this opportunity in the first place. So Fiat Chrysler back in 2012. And being the top bloke he was, he let Guy know about it. And after Guy had had time to think for himself, he decided to buy into Fiat Chrysler as well. Around the middle of 2012, Guy bought $10 million worth of Fiat Chrysler shares. And inside Fiat Chrysler, Ferrari was there as well. Now, over the years, Fiat Chrysler recovered from the bailout, and then in 2015, he got 1 share for every 10 Fiat Chrysler shares. Now, Guy actually held onto those shares, and majority of them, until about 2020 during COVID. And around that time, he decided to sell some of the shares off. So he decided to trim that portion, buy something else, and what did he actually think of that? Well, quote from him in his 2020 report: "Thanks to my prudent decision to trim that flower," being Ferrari, "we've missed out on millions of dollars in additional gains." He also sold some more shares in 2024. But why? So this is a bit more of my take on it. I tried reading through his report. I don't know if I was getting the actual answer for why. It sounds like he was more worried about the short-term volatility. So the stock price of Ferrari going up or down over the short term, and that having an impact on his family and his own investment in his fund. At the end of the day, I think it truly comes back to what he actually mentioned in his 2021 report. The trouble is, it's difficult to buy a great business once, let alone twice, and have no confidence in my ability to trade in and out. I'll let Charlie Munger's wisdom shine through here. So in Berkshire Hathaway's annual general meeting of 2000, Charlie's talking about different types of investing. The investing where you find a few great companies and just sit on your ass because you've correctly predicted the future. That is what it's very nice to be good at. It's not a mystery to find great companies. You just need to know what to look out for and what to avoid. I'll show you how for free in the link in the description. Now, if Guy had held on to all of his shares, in 2024, he would have $85 million instead of $25 million. But consolation prize though, from that $10 million original investment that he had in Fiat Chrysler in 2012, by 2017, the Ferrari shares alone were worth $20 million. In his 2017 report, he explains, in other words, you could argue that we got Ferrari at half price and got the rest of Fiat Chrysler free. Pretty exceptional. And they've turned that $250,000 into $25 million, the 100x return. Even if you are able to find a winning stock like Ferrari, there's 3 things you need to be able to master, otherwise you'll sell early and always lose money. You can watch this next video and find out how.